What's happening on Wall Street right now, honestly, it feels less like market analysis and more like some kind of gripping thriller. I mean, the biggest names in tech, the ones we all thought were basically invincible, are suddenly showing some serious cracks in their armor. So let's get right into it and figure out what on earth is going on.
You know, for years, we all kind of put our blind faith in the Magnificent Seven. You know who I'm talking about: Apple, Microsoft, Nvidia, the whole crew. They were the engine literally pulling the entire stock market uphill. But that mood, it has completely shifted. The era of just believing is over, and investors are finally asking that one tough question.
Where is the money?
So, to make sense of all this chaos, here's our game plan. First, we're going to look at the massive bill for this AI gold rush. Then, we'll see how these giants are actually splintering apart. After that, we'll check out the cracks appearing in the system itself, deal with those nagging fears of another dot-com bubble, and then, the important part, we'll build a brand new playbook for you, the investor. All right, first up, the absolutely astronomical price tag of this AI revolution. Everybody wants a piece of the AI boom, right? But it turns out the cost of admission is, well, it's staggering, and it's starting to make Wall Street really, really nervous.
The key word here, the one you've got to know, is CapEx, capital expenditures. Just think of it like this. AI is the most exclusive, high-stakes club in the world, and CapEx, that's the membership fee. It's the billions and billions spent on data centers, on chips, on all the physical stuff you need to make the AI magic happen.
Okay, so let's put a number to that fee. $37.5 billion. Now, to put that into perspective, that's more than the entire annual GDP of some countries. And that's how much Microsoft spent on AI in just 3 months. So, even though their big picture results were great, this one number absolutely terrified investors. It caused the stock to have its worst day in 6 years.
And if you thought that was a jaw-dropper, hold on. Alphabet, Google's parent company, just announced it's planning to spend somewhere between $175 and $185 billion in 2026. So the market is starting to ask a very question. Are these companies just burning cash faster than AI can ever hope to earn it back?
So all this crazy spending is creating another huge problem. The Magnificent Seven, well, they aren't so magnificent together anymore. The whole group is starting to break apart.
And this quote, wow, it just nails it. For years, the Magnificent Seven moved like a wolf pack. You know, if one went up, they all seemed to go up. But that pack has scattered. As the quote says, it is clear that this group is falling apart. We're in a whole new ballgame now, where each company has to hunt on its own.
And you can see that divergence right here on this chart, clear as day. Back in January 2026, you had your winners, like Alphabet and Meta. They proved that AI could actually boost their cloud and ad businesses. But then, you have the strugglers. Microsoft, despite its big AI talk, dropped 12.5% because of those spending fears we just talked about. And even former titans like Apple and Tesla are stumbling. The herd has officially scattered.
Now, behind all these financial headlines, there are even deeper cracks starting to form in the very foundation of the tech world. And we're talking about real-world physical limits and a very, very real human cost.
So let me introduce you to a new word for your vocabulary: Ramageddon. It's not an exaggeration. It's a critical global shortage of these super specialized memory chips called HBM that are literally the lifeblood of AI. Without them, the whole AI revolution just grinds to a halt. This isn't some software bug you can patch. It's a fundamental supply chain crisis. And then there's the human cost. In 2025 alone, 127,000 tech employees just in the US lost their jobs. I mean, that's enough people to fill a massive football stadium. But here's the thing, this isn't your typical recession layoff. This is something completely new. Companies aren't laying people off because they're failing. They're laying them off because AI is making them more efficient. This is the cruel, hidden tax of the AI transformation.
So you've got this wild spending, supply chains in chaos, and massive layoffs. It's a level of disruption that's giving a lot of people some serious flashbacks. And it all leads to that one big, scary question that's on every investor's mind. Are we about to relive the dot-com bubble bursting all over again?
And the answer, thankfully, seems to be no. This slide tells a really powerful story. See, back in 2000, tech stocks were trading at this insane 60 times their earnings, and most of those companies weren't even making any money. Today, that ratio is a much more reasonable 30, and companies like Nvidia and Meta, they are absolute profit-generating machines. It's just not the same scenario.
But just because it's not a bubble, that doesn't mean it's business as usual.
Not even close. Think of it this way. For years and years, borrowing money was practically free, and that encouraged companies to spend like crazy on risky bets. While now, with higher interest rates, money is expensive again. And that means every single dollar a company spends has to be justified by a clear path to profit. The party's over. It's time to pay the bill.
And hey, on top of everything else, a new sheriff has rolled into town: regulation. You've got the EU rolling out its AI Act, which can slap companies with massive fines. And here in the US, the Department of Justice is threatening to break up Google. This just adds a whole new layer of risk and uncertainty for these giants.
So, after all of that, what does this actually mean for your wallet? Has the bear market finally broken big tech? Well, not quite, but it has definitely shaken things up in a big way. It is absolutely time for a new investor playbook.
So what's in this new playbook? It comes down to 3 key rules. Rule number 1, demand proof. The AI hype train has left the station. Now it is all about profits. Show me the money. Rule number 2, be a sniper, not a shotgunner. The days of just buying the whole tech sector and watching it go up are over. You need to pick your targets carefully. Focus on the companies that are actually efficient. And rule number 3, look beyond the usual suspects. The Magnificent Seven have hogged the spotlight for so long. But hey, there are 493 other companies in the S&P 500, and a lot of them are starting to wake up.
Right now, the market's mood ring, the fear and greed index, is sitting firmly in the fear zone. Now, for a lot of people, that's a signal to run for the hills. But for many savvy investors, fear in the market is often the clearest sign that a really good buying opportunity is just around the corner.
So, we'll leave you with this one question. The world of tech investing has fundamentally, completely changed. The old rules just don't apply anymore. The giants are being forced to adapt, and the only real question left is, are you ready to adapt with them?